Moving on, we have Shailesh who sent us a question through email. Now, he says that he has a sum of 5 lakh rupees which he could either use to prepay part of his home loan or invest it in equities or mutual funds. If he was to go for mutual funds, which option would be the best? Could you suggest that? He's not invested in mutual funds so far, or should he just clear a part of his home loan? Karthik, these are the kind of questions that you enjoy answering.
Yeah, absolutely. I mean, you already know that. So what happens is, basically when you're making a prepayment, there's no problem. But when you make a prepayment of a home loan, think about it this way. That money is like a one-way street. The money doesn't come back to you, nor can you use any opportunity that money can create for you. Which is why we are always of the opinion that when you have money in your hand, it's always better because you can invest that money. That is your capital. The capital can grow. You will have some profits on that capital and use those profits to make your prepayments. So thereby, what happens is you are actually also in some sense reducing the interest burden on your home loan. And over a period of the entire home loan, when you make multiple such prepayments, net you are still better off because you've had your capital in your hand, A, and B, the property price that you are having is already increasing, and C, the home loan rate changes as interest rates move in the system, and as in when we have a situation like now where the interest rates are going downwards, you're again saving so much. So just don't use up, because it takes a lot of effort, many months and years of savings to conjure up a little bit of a corpus, and just giving it to a home finance company is just one way gone. And you'll never have access to that money. You'll never be able to explore the opportunities that money can give you. And from a liquidity standpoint, it's again a very, very wise thing to not have only real estate and only pay EMIs, have no savings. So it's always good that in a rainy day scenario, or if you lose your job, or if there is anything that happens, or if there is any contingency that you have to go under, you have liquidity, you have some cash available, some money available for any purpose that you might need to.
Right, Karthik, and first-time investor, what would you advise? Any particular funds that you would want to recommend over here?
So yes, what you could do is you could make a portfolio of blue chip funds, blue chip mutual funds, and the other 50% of your money you can consider doing in mid-cap. If you're not happy with mid-cap, just go 100% blue chip and diversified kind of funds, which are large caps essentially. And that way your portfolio will have the least amount of volatility, and it'll keep growing in line with the market.
Very technical terms over there. Considering that he's a first-time investor, right, what is a blue chip fund? Could you give him some examples? And what do you mean when you say large cap?
Yeah, absolutely right. So what happens is large cap companies are the very large companies like your Britannia, your Nestle, which have been established for many, many years together. So when we call a fund as a blue chip fund or a large cap fund, what's happening is that this fund manager of this particular fund is investing in companies which are extremely well established, have a huge market capitalization. So to say, they are very large and established, and the chances of those companies going under or their profitability suffering is very, very low. So, but at the same time, because they do not have the potential to grow and multiply over the years, therefore the growth is also to a certain extent restricted there. So those are the large cap funds for you, and mid caps are the younger companies which have the potential to grow faster. So they multiply your wealth faster, but they are also risky in a down market scenario where the markets are going down. Then you tend to lose money also a little faster in that kind of a fund, which is why I'm saying that allocate your money 50-50 into both these funds and stay invested for many, many years together. Run through one whole cycle, run through 2 cycles of the stock market, which is typically an investment of 8 to 10 years. You will in the process see many years of very good profits, and that time you can use these profits and then make some prepayment. Thereby you will get best of both worlds.
So essentially very similar rules to play by whether you're investing in the real estate market or the stock market. Do your research. Research is key to a good investment, and of course stay invested for the long term. That'll get you the best returns.
You can watch live TV on our website mpnow.in. Find us on Facebook at facebook.com/magicbricksnow. And don't forget to click the like button. You can also follow us on Twitter at magicbricksnow. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/magicbricksnow.